I spent my summer here at home in Scotland, and how do you know when it's summer in Scotland? The rain gets warmer. And it was a bit like that this summer, but no, it wasn't too bad at all. An economy is going to be affected more and more by political reaction to climate change and by how popular opinion reacts. Last year's German economic slowdown was partly due to lower auto production because of new emissions tests brought in by Dieselgate. Jaguar Land Rover wrote off 3.6 billion at the end of last year, largely due to political climate-related decisions about diesel engines. We lent to them, and we had to downgrade the risk 2 notches. More capital needs to be applied. It becomes a more expensive loan in our portfolios. The Yellow Vest Gilets jaunes protests in France were triggered by political petrol tax increases related to climate concern and contributed to reduced activity in the service sector in the fourth quarter. And the seriousness with which we are all treating climate risks is suddenly evident, as though the financial community has crossed some sort of credibility line when it comes to looking at climate risk, literally in just the last 2 years. It's no longer just for environmentalists, that stopped a few years ago, and it's no longer a marginal financial product. For us in finance, the goal is clear. If there is a climate risk which can be identified, then it can be measured. Then we can meet the risk, building resilience on the one hand, and making better, perhaps more ethical credit decisions on the other. And for doing that, we should be seeking ways of achieving a lower Pillar 1 capital weighting for those loans, making green loans a better loan in every way. If we crack that, we've cracked climate risk challenge for banks. And I can tell you that we, along with several other banks that I know of, are actively looking at how to bring in differentiated risk ratings based on climate, as well as the usual credit factors. We're doing it right now. I expect it to come in next year in our bank. So any banker or investor who is not thinking now about how to introduce this aspect into their analysis of companies is likely to underperform. Similarly, I don't meet any corporate treasurers or finance officers who are not aware of the need to address climate concerns from shareholders, investors, and risk analysts. We know this. A decade ago, sustainable investment was about signaling awareness, sometimes at the cost of a slightly lower return. In the last 5 years, most investors have started to assume that they can do this without sacrificing return. The reality is that both green bonds and sector-neutral equity ESG strategies have been outperforming their benchmarks for at least 2 years. This is a trend that will only get stronger going forward because it's not now just about signaling awareness, but about mobilizing capital for better business investments that can speed up the transition. Most banks I see are overexposed to risk and underexposed to opportunity.